are already going on their holidays and apparently happy to do so. Omicron is fading into the background, it would appear, and nothing is deterring this market momentum. We have oil markets last week, biggest weekly gain since August. Let's kick off with our regular Sunday morning commentator, Christoph Ruhl, Senior Research Scholar at the Center on Global Energy Policy at Columbia University. Christoph, it looks like there's absolutely nothing to stop this market from its year-long euphoria. Why would it end now?
I don't quite see that euphoria anymore. So I see stock markets much more wobbly. We're getting still reactions to news like Omicron, and then it was down. It didn't go back quite to the level where it was before. And this kind of dithering has been going on for weeks now, reinforced by the Fed discussion and all that. So it's not yet the proverbial hockey stick before the crash, but it seems to be slowing down a little bit. And on oil markets, I share the more bearish sentiment, frankly. As I always think, what we are seeing is that demand is way not as strong as predicted by many analysts. Still not quite back into where it was 2019. In fact, it behaves just as if Corona wouldn't have happened. The decline in demand year after year by increased efficiency improvements is with us, which would indicate that the demand forecast of even the downward corrected ones from the EIA would have to be corrected downward a little further. What has happened already in America in terms of forecast correction will happen globally as well from the IEA, correct? And I think that we now had the carrot of high prices with us long enough to see a supply reaction as well. As we look at the drilling rates, we see some more shale coming on in the spring, and private supplies from elsewhere in the world, Guyana, Brazil, North Sea, and probably, but I wouldn't count on that, even from Iran, Venezuela, these kind of politically motivated outages, which have nothing to do with OPEC. So OPEC Plus still has its work cut out for it. And what I think is for a while now in the winter, until the summer driving demand picks up, we'll be in this range where we are right now. So I don't see it improving week after week after week as it did a few months ago.
Let's welcome back Malia Bengali, founder, MB Commodity Corner. Malia, we had the US inflation numbers in last week, and I believe it was the highest, 6.8%, the highest level since, biggest annual gain since 1982. What did the markets do? They broke another record on equities. I mean, nothing is stopping this market. Your thoughts?
So you're absolutely right. Inflation has hit a massive level. I think the market's more concerned about the rate of change of the inflation rather than the inflation number itself. You saw Biden coming out and saying how the recent energy price falls and gas prices would not be reflected. Having said that, I think the market in the last month has been very worried about the macro picture. Inflation is a huge concern, and the Fed and what they do with their balance sheet is a concern. So the S&P actually fell in October as we saw it fall back down. But right now, the Fed's still adding liquidity. The balance sheet made new all-time highs, and that is what is really driving the S&P. And the shorts got massively squeezed out. On the derivative side, which is very interesting for December because we have the quadruple witching expiry, a lot of the put optionality is centered around 4,600 to 4,700. And it's a very technical position because market makers are short gamma. It's a bit technical. So what happens is that short gamma causes a lot of volatility in and around the strikes. So a lot of people got short and then got carried out on the upside. Markets are strong right now, but the main thing is if the Fed withdraws liquidity, starts tapering more aggressively, as inflation is a huge concern, then the market come back down. And that is going to be the key answer we get this week when the Fed meets on the 15th of December.
Christoph, your thoughts on the inflation piece and the potential for accelerating the tapering process, if indeed that is the option taken. It's hard to see anything else would be on the table at this stage.
Well, they will be careful about that. So inflation is real, it's with us, it's a concern. Is being pushed higher by and explained away by some analysts by these supply disruptions and these bottlenecks which we have in the supply chain. But in reality, of course, it's driven by the wall of money meeting these supply chains. And so, as you say, the only way to reduce that wall of money would be to start tapering and slow down these asset purchases. And we have gotten the signals that this may be accelerated, and we've gotten, just like in 2012-13, the immediate market response going down in disappointment. There's a long history, unfortunately, of both the Fed and the ECB to be asymmetrical and to err on the side of caution. So every time the question is to put up interest rates and to stop buying papers in the market, injecting money into the system, they are much slower, much more worried about the equity market reaction than when it comes to giving support to the equity markets. And I'm afraid this is likely to continue. So we'll see a few more hiccups and then maybe a slight accelerating and tapering in the US, but not in Europe. And what that will do is that Europe will be even slower in admitting to the inflation problem, even slower in announcing interest rate increases. And what that will do is will increase the exchange rate differential. So the US dollar will become stronger in expectation of higher interest rates. And that may buy Europe, which is completely dependent on exports, the cheaper euro may buy it some additional time. But with the global situation as it is, and with full employment in the Central European export countries, that will also give them more inflation. And then the ECB will have a problem too. And we are now getting, the interesting question now is, like Malia said, it's not so much whether we get 6 or 5.x% inflation every year or every month, but whether this will start to accelerate. That's the point at which expectation changes and at which it will go into price increases, wage increases, feeding each other. And I think we are not too far away from that point in Europe, especially given that background of supply constraints, lower exchange rates, and full employment, which we see everywhere. I mean, for Christ's sake, yesterday we came late, arrived in Germany. I was ordering some sushi, which is difficult enough. You have to pick it up yourself because there's no more delivery drivers. And then they tell me they can't give me sake in a bottle because there's bottlenecks, supply disruptions. So they had to put it in a plastic cup, and I would please warm it up at home. You know, it hits you at completely unexpected places, you know, but it does. It's there. It's real.
Yes, you got the combination of both the bottleneck and the inflation. But ultimately, Malia, it's hard to see it interrupting things at this point in time. I'm wondering what you think the legacy of Omicron is. Are we potentially in a space where, you know, the boy cried wolf? Next time there won't be a really reaction, given the last time it was so dramatic on the oil markets. We saw a 10%, 12 or 13% collapse in a day, and it's turning out not to be the big bad wolf.
Okay, so our view has been slightly different. We don't think Omicron was the main reason why the oil market fell. We think that was the trigger, the match that sort of lifted the fire. We've always posited that between October and December, there's a shoulder period. Oil demand falls after the summer and before the winter heating starts, and that every year we see a massive correction. And this year at 85 and 86, all the sell side was talking about a massively bullishly priced market. If demand opened up, you know, travel rebounded, not everything was pricing for a very rosy scenario. No one factored in any sort of weakness. Yes, there is a case that if we get all the economies opening up and travel demand goes back to 1.5 million barrels per day, oil price can go to 100, but we had priced no margin for error. So the Omicron, which is obviously a big risk, it just delays the recovery a few months more out. And I think that's where the market, being very long, got hit back on. And also don't forget the bond market, the rates market, the macro markets have been suggesting yield curve flattening. There's distress in the rate market. There's distress in the bond markets. The oil markets and the equity markets are just late to react because end of the day, it's all one big macro trade. We've always said that. So the yield market, the bond market.
And when you say the big macro trade, you're saying we're essentially in a sentiment-driven, all boats are rising to Santa Claus.
The macro trade is pretty much the liquidity trade. When risk on to all the sort of asset classes, every asset class is pretty much a bait on the same trade, whether it's Bitcoin, oil, or equities. But essentially, it's about the liquidity, right? So when
is there anything structural to that as we come to the end of the year?
Correct. So we were saying that the bond market, the yield curve has been flattening aggressively. So they consider a Fed policy error. Now it remains to be seen what the Fed does. We think they're a bit of a catch-22, right? Inflation is really high, but we're going back to pre-employment pre-employment. Why do we still need $120 billion a month of aggressive QE? And if they stop right now, how will the market survive at a time when growth is plateauing? So this is a bit of a dilemma the Fed has, and no one knows how they're going to attack this right now.
Christoph.
I disagree. I mean, number one, the oil market is not driven by these technicalities. It's not regularly increasing in the fall falling in the fall and going up in the spring. It's not that simple. It's not driven by trading. This is still a market driven by long-term fundamentals. The key variable, which will tell us what happens here, is that in everybody's expectations, the delta of the demand increase for 2022 is still less than what we have in excess capacity, right? So in everybody's book, the delta demand, the change in demand for next year is less than what is available if there's no politics interfering. And that's why we have a good old fundamental equation here. We have to figure out what will happen to demand, which probably will slow down a little bit more than analysts expected and has done so already. And we have a supply side, which is controlled by OPEC Plus, which brings us into the territory, what will happen with US-Saudi relationship, what will happen with Iranian relationship and the Gulf countries, what will happen with Russia and the Ukraine and the big unknown there. These are the fundamentals on which expectations are built, and the expectations create these short-term wobbles. And the general stock market is true, it's driven by liquidity, but I'm actually impressed because, John, you asked for structural shifts, and they are there. You can see exactly how sometimes value stocks go up, sometimes growth stocks go up, sometimes tech goes up, goes down in response to these various Fed guesses and announcements. And looking at the Fed all the time and trying to derive everything from there underestimates the fact that the Fed people themselves don't know what to decide in a few months. And it's a bit like the old criminology. I mean, we try to read something in them which probably isn't even there. I think as long as the tapering is with us, the market generally will rise. But the allocation of these increases across sectors is actually quite interesting, quite pronounced. And this is it's not yet a hockey stick where everything just explodes. That happened for a while with the ESG stocks probably, and for a while before with the tech stocks, the Teslas of this world. But that's starting to get wobbly. So it's not like in this last phase, which you always have before the rate. If there's a real stock market cost meltdown, it always gets up in this indiscriminate fashion. That's not the case yet.
Maliha, we're looking again, just to check in on China. We have Evergrande defined by some of the rating agencies as in default. They can't pay their debts. It looks uncertain whether the Chinese government wants to bail them out in a classic sense or not. Too big to fail, as the Americans bailed out their banks a few years ago. How do you read the situation in China and its impact for the markets, and particularly energy demand going into the end of the year?
I think China is supporting the market in the background in the way it wants to. So I think it's going to let Evergrande collapse the way it has. You've seen property developers collapse, but on the behind the scenes, they are acting liquidity and they're actually raising ratios for banks to give out loans. So they're sort of trying to stem sort of little holes in the market, but they will let the bigger players sort of delever. So that is the grand scheme of things. End of the day, they will not let this be a financial Armageddon. They are not. And you can already see right now, given the rate of change of the credit impulse data that we are forecasting, we've seen a slight uptick in November as opposed to the downtrade that we've seen since last year. So China's quite smart about what they're trying to do. They're trying to get rid of all the excess, but trying to support the underlying market. And I think that's how we see it. The key thing is, what will China do going to the Beijing Olympics into February 22? Since last year, they've also been deleveraging. And the question right now is, do they start re-accelerating demand into that sort of Winter Olympics demand?
And do you think they will, or where do you think that goes? I mean, typically going into the China's New Year, you should see an uplift in oil imports, but at the moment it's not coming.
We saw a small uptick back in November, so we think the demand will be strong. October, November, December, Jan is always a strong demand month right now, so we do not see it falling back down. We see it actually staying here to going more, slightly higher, effectively. Of course, forgetting the fact that the Fed does not do a massive aggressive taper that they did back in 2018, we're seeing a demand uplift into Q4 right now.
Christoph, your thoughts on where China plays as we come to the end of the year? It had a soft year and after a bionic one last year, and it hasn't really sort of derailed the recovery in the markets or the oil price in 2021. Bit of a surprise in a way.
Yeah, and a bit of a black box, of course, as ever. But what we have seen last year is, number one, something important on the policy side. This is really Xi sort of asserting his control, making it very clear that he sees himself as a leader on a par, at least with Deng Xiaoping, if not with the great leader before. And then translating that into sort of a wave of clampdowns on all sorts of liberal expressions. And what we are also seeing is a market which sort of structurally slows down as it changes from industry and investment into consumption and services. And on top of that has built up a lot of 6 or 7 different corners, from banks to proxy banks to the real estate markets, of areas where there's froth in the market, where there's too much liquidity, where it's over leveraged, where it's actually dangerous. And they're trying to tackle that. And this is always the point when you have a modern financial system, or you try to slow down stock market exuberance, where the old recipe of crossing the river slowly and of making 2 steps forwards, 1 step first, which worked so well when it came to privatization, to building up the industrial sector, and so where that one fails, because there it's very difficult to go 2 steps forwards, 1 step first. As soon as you go back, you try to contain a market which needs the liberal environment, needs free trade, needs free interaction, and then has a tendency to run out of control. And nobody, and not even the Chinese, have the luxury of putting sound institutions there first and then fill it with a modern financial system, modern sophisticated system. And what this means is that sooner or later, there will be a financial crisis erupting from somewhere. And what you can do beforehand is only to cover these other corners in the market to avoid contagion to the extent possible. Can they do this forever? It's everybody's guess. So far, every country which we have seen to go through these phases of development has had its share of financial instability and financial crises, and China is not likely to be an exception. So on top of the structural slowdown from 8.5% to maybe 4.5%, 5%, 4%, we will have this danger of financial instability coming with us. And given the mentality of the system there, that means the occasional lockdowns in economic sense, not because of the virus, but for market activity. And that is not a picture of oil demand increases on a par of the last 5 years. That's a picture of oil demand increases slowing down. And we should not forget that in the global picture, demand centers like China, also the Middle East and India, where oil demand is still growing, becoming much more important, because in all the other areas, including the US, but particularly Europe and OECD Asia, demand is falling. So as soon as the steam goes out of China, it's not just a matter of slowing oil demand globally. It becomes increasingly a matter of the tipping point approaching at which global oil demand will no longer be positive. And that also should happen this decade.
Well, it is the first year in, I think, 20 that oil imports into China will decline year on year. It never happened before in the modern era. Let's get the survey question in, and then get Malia and Christoph to give us their reflective thoughts on the year that has just passed and outlook for the year ahead. Survey question is coming up. Irene, I think you have it there. I can't see it, but maybe it's up there, is it? Have you put it up?
It's up there.
It is up. Okay, I can't see it for some reason. Oh, there it is. There is noting, as in nothing, now going to stop the Christmas rally. Record equities and $80 Brent. And a bit of cheer. Agree or disagree? Agree or disagree? There is nothing now going to stop the Christmas rally after Omicron has been more or less dismissed. Record equities and $80 Brent. Malia, if I was to sort of put to you, reflective. Here we are, mid-December. We're all sort of winding down for the year. Market's still on a tear. But one reflection, let's first tackle the year that's just gone. What might be, 1 or 2 surprises that, besides anything to do with COVID perhaps, but 1 or 2 surprises that you reflect on the year past?
I think the surprise has been more on the, I would say, the US administration's relationships with OPEC. You've seen some sort of arguments in terms of, sort of lack of communication in terms of the philosophy of US on oil versus OPEC. We've never really seen that happen. Usually they work in quite sync with each other. And I think it feels that OPEC has their own sort of budget spending and plans and future vision as to how they feel oil policy should be. The market has been trading aggressively all summer throughout to 85. And OPEC consistently said demand has been weak. We are too scared to release too fast. Whereas the US has sort of positive the other way around. That's an interesting sort of change in relations we've noticed a bit. Other than that, I think the...
you would certainly say in that space, Saudi and Biden, MBS and Biden do not have any public love for each other. Let's just put it that way.
Correct. It's a lot more vocal than behind the scenes from our point of view.
Anything else you would take from the year past?
Other than that, no.
Surprise.
Well, the central banks have not really surprised us. Central banks have been on this path for the last 12 years. And
right.
never seem to surprise the fact that, when times are really good back in the summer, that's when they should take the balance sheet down. We're now at $9 trillion nearly. And the fact that we are back at market all-time highs when growth is plateauing is going back to where we were back in 2019. So it'll be really interesting because that debt bubble is getting bigger and bigger. So we're just concerned how the Fed officials can be so blatantly, ignorant about the consequences of that.
Perhaps we're in a time now where even the Fed is too big to fail and the rest of the world will bail it out. I mean, that's a big bet to make.
Right.
Christoph, your thoughts, year in review?
Well, let's see. I think I would, on the policy side, well, let's start with the virus.
Right.
I think there's some good news on the virus side, because increasingly the world realizes the importance and the hope which lies in vaccinations. What we haven't done, of course, we haven't thought about the other half, the poorer countries who are not vaccinated. And in that sense, this Omicron was probably the right wake-up call. We need to get everyone on the planet vaccinated, and then this virus can be dealt with like any other flu-related disease. So it's the right thing, highly infectious and pretty shallow if it stays like that. It's the right sort of confirmation how to get this problem off the table. That's good news. On the policy side, I would expand Melissa's point. I'm very surprised or disappointed by how the Biden administration had this stellar start. The first 100 days, they moved on so many fronts at the same time, unwinding Trump things and creating new initiatives all around the world, and how that quickly has run that out of steam. Now Putin is playing his games with them. The Chinese are further distant than ever. The relationship to energy policy is just incompetence, I think. And then the relationship to OPEC Plus is on this unhealthy level of asking for more, asking for less in order to satisfy the American driver. That's not a very sustainable basis. So that is a policy disappointment and a threat for things to come, because there's enough Putins and Erdogans and Xi's in the world to use that. On the economic side, I think the big developments are ahead of us. And this will go on, including probably a Christmas rally, just a short-term sort of liquidity thing, like a rudderless ship in blown by a strong wind, as long as this liquidity is there. Once it comes to removing this liquidity, either by initiative of central banks or because they're forced by inflation, we will enter a much more difficult territory.
Yeah, I would think for me, the surprise of the year has been China's slowdown, implosion. I mean, not to use anything too dramatic, but certainly just suddenly becoming less than, after such a bionic first year of COVID, a second year that has been a black box, as Christoph says, and ultimately a black box that at some level seems to be in a downward move. Malia, your thoughts on the year ahead? What do you think? What are you going to be watching out for? What might be the surprises of tomorrow?
For us, the main thing is liquidity, dollar, and the bond market. I think that and how that plays out in terms of the Fed policy. We think global GDP growth right now is at a risk of probably plateauing to slowing down. The car is running out of juice, as you can say it. What will the Fed do? How will they tackle debt and inflation? And I think the rate of change of inflation, we still see supply tightness over the next 3 or 4 months, but effectively the Fed's just waiting and hoping for that to come back down. They might just buy themselves the room to sort of ease policy and keep it loose going forward. So there are lots of moving parts right now. It's very uncertain. It's not as easy as before. I think.
Do you see anything in that equation, Malia, where the Fed could get some hawkish teeth?
If oil prices and gas prices you're seeing right now, they stay the way they are right now and supply chains do not ease, I think they may be forced. The bond market may force the Fed's hand to taper. They might have to. They know they can't raise rates. And if that happens, it might actually be better for the markets. So it is very uncertain. It's not as easy as before. It's not just by the dip trade. There are a lot of moving parts to this macro trade. And I think that's going to unravel the puzzle, we feel, going forward.
And just a sort of a local question, I mean, in context, I'm not sure where you are at the moment, but you do spend a lot of time in London. What's the outlook for Brexit and Boris Johnson and all things to do with having parties when you shouldn't have?
Not very positive. It certainly isn't very positive. I think people are more worried about the vaccine passports and the things going forward other than anything else. And they've also changed gears and becoming more strict with the mask mandate, but things are not as positive, and there's a lot of disagreement between the vaccine mandates going forward.
I get the impression that his buffoonery has kind of weared out. People are kind of bored with it, no longer giving it much joy as it may have been entertained in the past. It now just looks juvenile. Let's go to the survey result and get Christoph's last word this morning. Record equities and $80 agree 2-1. There's nothing now going to stop the Christmas rally. Christoph, your crystal ball year ahead, your last Sunday with us before you get a month to relax.
I would agree on the uncertainty surrounding the economy. I would think that in the energy space, we've seen an encouraging development, which is sort of the oil and gas industry fighting back a little bit and saying, hold it, you can't just replace us with something else, because there isn't something else which can replace us. And we need the space to do investments and to provide the basis for this. So you can have a transition only if you have energy security with respect to oil, gas, and coal, I'm afraid. So that becomes more, that's a positive, encouraging development, more realism there. Policies I see sort of just deteriorating with further dents on globalization. And the economy, we had the 7 good years now, and whether it's possible to steer it through, to continue steering it like this, I simply don't know, and nobody can know. It's genuinely much more uncertain than we knew. And the black box, China, I agree with you, is certainly a black box which is swimming down the river, not crossing it anymore. So to stay in their picture.
And my thoughts of the year ahead, I think, is, as we say, obviously all the things you guys articulated are so critical. Putting outside of that, I would be saying geopolitics. Where does Ukraine, Putin go? Where does Iran go? And the sort of Taiwan piece. I think that if I was optimistic about 3 of them, I think I might be most optimistic, surprisingly, about the outlook for the Iran talks. I think Taiwan will continue to fester and continue to be a disruptive force as China sort of gets more robust in its attitude. Putin and Ukraine, it's kind of a wild card. All the logic would be don't do it, but at the same token, you can't underestimate how important Ukraine is to the psychological, cultural, and political stability of Russia, or at least the elements within Russia. So that's not an insignificant face-off there that needs some attention. So I'm going to go most optimistic about Iran, and as a result of that, our region here might see a new dawn with a rehabilitated Iran and one in which things calm down a little bit. That might be a bit kumbaya, hopeful expectation, but I think in terms of making a big change, that could be the one. But listen, Christoph, thank you so much. Sunday mornings isn't the same without you, but I'll have to cheer Christmas and Santa Claus instead. So thank you, and have a great Christmas with your family, and your kid, I'm sure, will be wonderful and in good shape. Malia, thank you as always for joining us monthly, and we look forward to seeing you in the new year. Have a happy holidays, and we'll be here every morning this week for the last few sessions before breaking on Thursday. Thank you so much. All the best.
Thank you. Same to you. Happy
Cheers.
season.
Sláinte.